that we would be concentrating on inflation and the Fed's interest rates and the likelihood of recession. But with the recent banking failure, I've asked him to discuss something about the safety of our money and deposits. It is my pleasure to introduce Dr. Mark Sniderman. Dr. Mark Sniderman's academic interests and professional interests are focused on macroeconomics and financial regulation, especially the role played by central banks. He came to Case Western after a career with the Federal Reserve Bank of Cleveland, where he served as Executive Vice President and Chief Policy Officer. He was Principal Advisor to the Bank President for Economic and Financial Policy Issues. He chaired the bank's Senior Policy Committee. He received his PhD from the University of Wisconsin, his bachelor's from Case Western Reserve University, and currently serves as adjunct professor, Department of Economics in the Weatherhead School of Management. I've given him extensive leeway to discuss a variety of issues. And after this, let me just turn it over to you, Mark.
Good morning. Thanks for the introduction. Thanks, Jonathan. It's great to meet you. I've been here before on a number of occasions over the years. I know there's a Zoom audience out there too, so I say hello to all of you Zoomers, and a shout out to my friend Brian Larson if he's on the Zoom today. So good morning. And I know the weather is a little dicey, so it may keep more of you tuning in from at home rather than being here. But we have for those of you at home, we have a group of stalwarts here who are eager to participate in the discussion. So can't hear. So this is get myself closer. Okay, get myself closer. Okay. All right. So I had been working on this presentation for a couple of weeks before, oh, there's Brian. I thought you were online, Brian. Here you are.
No, my wife made me come today.
Right. So I had been working on this for a few weeks, certainly before the failure of Silicon Valley Bank. And as Jonathan said, we're going to focus on inflation and kind of the outlook for the economy. And I am going to talk about that to start off with, and then we can go and talk about Silicon Valley Bank, because that bank failure and some of the sort of excitement around it, and it's spreading to some other institutions, tension in the system is going to affect the outlook for the economy as well. It certainly affects my outlook, and I'll explain why that is. So let me kind of run through a couple of pictures here first to give you a setup of where we are with the economy. So, in a broader context, I guess I should also say we've had quite a difficult several years. Now we have the Silicon Valley Bank failure as the latest monkey wrench in the work. But, if you think about it, times have not been normal since the COVID pandemic. So that has, in and of itself, created a lot of very unusual circumstances for the path of our economy and for the nature of the policy responses, and certainly the politics that have come into the country. So we've been in kind of unusual times for quite a while, and the bank failure and the tensions associated with it are going to create more uncertainty, as I see it, for the balance of the year. So this picture that I've got up here is kind of a way of summarizing a little bit about the overall economy. I've got the unemployment rate here in blue going back to 1990, and also the inflation rate. There are a couple of different measures you can use for inflation. They're all super highly correlated with one another, so I picked one out. So the red dashed line shows you the rate of inflation, the blue line, the unemployment rate. You can see we kind of have a lot of cyclicality. These vertical lines that you'll see in some of my pictures are always recession periods. So anytime you see that, it's when we have a recession in the US. And not surprisingly, the unemployment rates are rising during those periods of recession. And then they're falling again as the economy gets back on its feet and the economic expansion gets underway. This very sharp spike in the unemployment rate, no surprise, that's COVID. That's like the immediate shutdown of the economy. That's why you see that giant spike. But you can see before that, we've been making really great progress for a number of years since the great financial crisis in 2008, 2010, where the unemployment rate went up to about 10%. After we recovered from that experience, bit by bit, the economy kept growing and doing well, and the unemployment rate kept falling, gradually over time, to the point where it was down to around 3.5% or so, which is super low for the US economy. We haven't been down that low for quite some time. Those of you, here probably remember thinking unemployment rates around 4 or 5% were kind of much more normal for even good times. So unemployment was really quite low. And the inflation rate, by looking at this red line here, you can see inflation rates during this period post-financial crisis have been running around 1.5%. The Federal Reserve has established a long-term inflation objective of 2% as the average for the inflation rate, and we'd actually been running below that after the great financial crisis. So we were in really pretty good shape when COVID hit. In fact, we've been doing so well that there was this concern that the economy might start overheating and generating even more inflation. So the Federal Reserve was actually kind of in the process of implementing a tighter monetary policy to try to make sure the inflation rate didn't move back up above 2%. And that's when COVID hit. And then all bets were off. We got massive fiscal policy stimulus in the US economy to try to keep the economy from cratering. Monetary policy relaxed enormously during that period of time to, again, provide additional support to the economy. And after we got past the shutdown periods where the unemployment rate, spiked a lot, you could see the sort of real side of the economy, as we call it, the production of goods and services, that all started getting back to normal. It took a little while, started getting back to normal, and that's where you see those unemployment rates coming back down again. The problem that we found ourselves in was not so much that we couldn't get the economy back on its feet again on the real side of the economy, the production side of the economy, but the inflation side of the economy, the pricing side, wasn't back to normal. And that's because we had so many disruptions in our supply chain. Over the past 30 years, the US economy had been very adept at figuring out how to source all kinds of raw materials from all over the world in a very complicated, complex manner, where you'd get a little part of something made in Malaysia that would then get sent and embedded into another part of something in Indonesia, and then all of those things would go to China and they would get assembled, and then they'd go up in a big container ship and come across the ocean, and here we are, and we could buy them very inexpensively. Well, all of that began to unravel in the COVID pandemic period, and we found ourselves in short supply. We and other nations around the world found themselves in short supply of lots of critical goods and services and food. So inflation rates spiked up, and that's what we've been kind of dealing with for a while. As the economy settled back down into kind of more normal patterns of production, and businesses figured out how to source things or substitute things and kind of get the production back, the pricing side still hasn't recovered. And so that's been the process that, at least on the Federal Reserve side of its policy, it's been saying, hey, the inflation rate is just way too high. We're confident that the labor market is back on track. In fact, we have our unemployment rate back to 3.5%. The last report came out a couple of weeks ago. For February, the unemployment rate is 3.6. It just ticked up 0.1% from 3.5. So we're kind of back to where we were in a really vigorous labor market. There's a lot of demand. We still don't have the labor force participation rate back to where it was before the pandemic, meaning there are still more people who you might expect to be drawn into the labor force And so there's still more job openings than, than there to be filled. And so companies, businesses of all kinds are still looking for people. It's keeping wage growth, pretty good. But there's still a lot of pricing power in markets, and we see a lot of inflation pressure. And so up until this past week, the Federal Reserve has been, very resolute and determined about tightening monetary policy to try to get on top of inflation. And so far, it hasn't really been slowing the economy down all that much, which is a good thing. I mean, what we'd like to see is the economy continuing to grow, all the while the inflation pressures are going to get squeezed out. I mean, that would be like a Goldilocks kind of solution to our problem: keep the economy growing, but tamp down the inflation pressure. So that's kind of, in broad terms, kind of the macro environment that we're in. Here's a picture of the industrial production index here on the red line, and the scale is on the left. This is the rate of change of industrial production. So you see this big decline, that's COVID, when everything kind of shut down. Then we had this big surge in industrial production when everything kind of opened back up again. And now it's been it's growing, but kind of slowing down. And so the interest rate increases have finally begun to bite. The growth rate of the economy is sort of slowing down. Labor market momentum, which is just a composite index of a lot of different labor market conditions. I had an index for that in the dashed blue line. You can see that kind of flattening out, showing that labor market momentum is sort of slowing down. So the Fed's monetary policy has been sort of gradually taking hold. It's been slowing down the rate at which the economy is expanding, even though that unemployment rate is staying low, but the momentum is kind of coming out. That's all designed to start taking pricing pressure, inflation pressure out of the system. So all that has sort of been going on. And this is some interest rate information. So a little bit, two things going on here at once. Let's take the dashed blue line first. This is GDP growth after adjusting for inflation. So this is the rate of increase of production of real goods and services in the economy in the blue line. Again, you see the collapse during COVID down here where the recession bar is, the big spike up in growth rate of GDP once the production, kind of resumes, and then this kind of slowing down again in terms of GDP growth rate. So it's kind of mirroring that industrial production picture on the previous slide. But look here, I'm showing you on the red line, this is information about the slope of interest rates. And this is a commonly used predictor of GDP growth rate. It's like a way that financial markets provide some signal to us about what financial market participants are expecting to see in the future in terms of GDP growth rate. And what it is the slope. It's the difference between yields on 10-year treasuries and 2-year treasuries. So if you think about the yield curve, in normal times, interest rates at the short end are low, and at the high end, they're high. And so the 10-year minus the 2-year is a positive number. And that's a signal that people are expecting the economy to be growing and interest rates to be rising in the future. Rising because economic activity is increasing, and maybe because the Fed will have to start raising rates eventually to slow the economy down. When that yield curve inverts and the 2-year is higher than the 10-year, this number will be negative. And that's an indication that short-term rates being much higher than long-term rates means that financial market participants are expecting the economy to be slowing down. And with a recession possibly in the future, interest rates are going to fall as the Fed starts cutting interest rates to try to support more growth in the economy. So with that background, we can take a look at this chart, and you see the period where it has the arrow that says signals an economic expansion. The yield curve slope is steeply positive. It's indicating that people are expecting economic growth to pick up. And indeed, the economy was growing all during that period of time. And then you see the inversion of that yield curve, signaling a contraction. And indeed, the growth rate of GDP was slowing down. And you can see the yield curve, as of a couple of days ago, was very negative in this way over here. I think I can use this little pointer here, right? So signaling, hey, we're expecting to see the GDP maybe actually even declining. So signaling possibilities of recession ahead. And indeed, the probability of recession, according to a measure put out by the Cleveland Fed, looks something like this. Big spike up in the probability of recession recently. I should say before the failure of Silicon Valley Bank, the odds on there being a recession sometimes later this year, depending on who you ask, there's a lot of uncertainty about it. We're kind of from about 20% or so to about 65% or so. I mean, a lot of differences of opinion, even before the bank failure, whether we were likely to go into recession later this year or early next year. After Silicon Valley Bank, I think we're going to see expectations of a recession rising. And I'll explain why that is in just a minute. So predicted GDP growth based on financial market indicators. Here's the red line showing a recession, finally down like below 0. Inflation. So one thing that's complicating the inflation picture is that, if you think about the market basket of things that we buy, goods and services that we buy, it includes goods and services. It's got cars and furniture and televisions and can openers and pencils, like all kind of different things like that. But also medical services, internet services, medical services, all kinds of. It's a huge hodgepodge of things. And included in all of this is the cost of shelter, the expense of operating our homes. And for those of us who are renters, the consumer price index just has, they measure rents around the country and whether those are going up or down. For those of us who are homeowners, the CPI imputes a rent to us. It assumes that if you're a homeowner, you're implicitly paying rent to yourself through the occupying your own home. So there's a methodology in there that tries to take account of the fact that we need to try to get an estimate of how much it's costing us to live even in our own homes, even if we're not, even if we're owners rather than renters. The reason I point this out is because one of the biggest problems that we're seeing with the inflation measurement these days is in shelter costs. Finally, the costs of the rates of increase of prices of goods and services have started to come down. So over here, you see this dashed purple line, durable goods inflation. So all during the 1990s, the 2000s, 2010s, all the benefits from globalization, the supply chain that I was talking about, sourcing goods from all over the world, and productivity in manufacturing have been so good that actually the prices of durable goods that we buy were essentially flat or declining by 1% per year on average. The reason that we had any positive inflation at all was because we were getting increases in the range of, say, 2% a year or so on services on average. And that's why the total inflation rate here in blue, all during this period of time, was able to stay in this low range of around 2%, because it was offset between slightly falling durable goods prices and slightly higher rates of inflation for services. And rent is in this dashed red line. So even the rate at which rents were increasing was kind of on a par with the overall average inflation rate. And this rental component is large. It takes up like 35–40% of the CPI because it's such a big component of what we spend our income on. But look what's happened here. COVID, big spike in durable goods inflation when that supply chain got disrupted. That's finally come way down just in the past couple of months. The inflation readings have been really benign on durable goods inflation as that supply chain problems got fixed. And yet the rental component is still like way up here. So most of the inflation, when you hear that there's an inflation report, we just got one, around 6% year over year still is the rate of inflation. Showing there's more work to do for the Fed to get that inflation rate down to 2%. Most of that pressure is still coming from the shelter cost, the rental component of the index. And there's some good news there. And the good news for that is that the methodology that the Bureau of Labor Statistics uses to measure these rental prices actually is kind of a snapshot back in time. That extends back almost a whole year. It has a big lag in the process. And if you look at companies like Zillow and others that actually are on a daily basis sort of keeping track of rental prices and so on, Zillow has its own index called ZORI, Zillow's Owner Rent Index or something like that. And there are other services that real estate companies that do this too. If you look at their indexes in real time, you'll see those rates of price increase have come down sharply. So the official measures that are embedded in the CPI are actually a much worse case scenario about what's going on. And it suggests that if we project ourselves out to the summer and into the fall, barring any other changes, we should see those rental component increases in the CPI coming down so that by the end of the year, we would see much lower inflation rates than we're seeing now, just on that basis alone. So kind of hopeful that on the inflation side, there's much less price pressure actually in the system than looks like is coming through in the CPI itself. So here's like a closer picture of that, like what's going on today. It's the same chart I gave you before, but just for the past 2 years. You can see the improvement in the durable goods. You see that rent inflation still cruising up, but what I'm suggesting to you is it's sort of at its peak and it's going to be cruising back down again toward the end of the year. This is the Zillow index that I mentioned. The relevant one that we want to look at is the bottom part of this slide. It's the month-over-month rate of change of their index, the observed rent index. And you can see I've drawn like a dashed line there that shows you the direction in which that thing is headed. It's headed down. So up until a couple of days ago when we had the bank failure, what would I have told you about where interest rates are headed by the Fed? Well, I would have told you that the Fed has a meeting next week and they would be raising their target for interest rates by another 50 basis points, a half a percentage point, because they have vowed to stay on top of this inflation situation until we see much better improvement. And we haven't seen it yet, even though I'm telling you that, you know, it's probably going to get better even if they didn't do much, but they're not taking any chances. So they were headed for another 50 basis points and maybe even some more after that at one of their later meetings in the year. So we're expecting to see, you know, higher interest rates by another 75 basis points or so before the end of the year. So this picture shows you, again, the inflation rate and the dashed red line, too high. The long run neutral rate that the Fed believes it will eventually settle into is down here on this black line. So they got ways to go eventually to get the interest rates down, but that would only happen gradually once they fix the inflation problem. So That's an indication of how sort of tight monetary policy is. And the dashed lines that I have down here are both, they're designed to show you the financial markets projection of the long run inflation rate. So financial markets today, even though they see the current inflation rate up at around 6%, their expectation is that 5 years out from now and out beyond that, the inflation rate is going to be back to around 2%. So it's not as if, at least in the financial markets, there's the sense that there's going to be a runaway inflation problem that we're going to have to worry about over the next 5 years or 10 years or anything like that. There's a high degree of confidence in financial markets in the Fed that the Fed will do what it takes to get that inflation rate down. It's just a matter of time for its policies to work. And as I said, everybody was expecting the Fed to remain pretty vigilant at its meeting next week. And then we have sort of the bank failure. So here's the Fed's dilemma. So the Fed's been raising interest rates both to slow the economy down a little bit and reduce price pressures and to demonstrate its commitment to return inflation to 2%. The more credible its commitment is taken by people who are making decisions in the economy, people who are setting prices and wages, and you and I in our daily activities, the more credible we believe this, actually, it makes the Fed's job easier because the more people believe it, the more they start repricing things at 2% rather than at 5% or 6% or anything like that. Like if everybody expects the inflation rate to slow down, it's going to start behaving that way. So it makes the Fed's job easier. Before the recent panic, as I said, we're expecting 50 basis points, and that would bring the Fed funds rate, this short-term interest rate that the Fed sets, to the range of 5 to 5.25%. And all the CD rates and things like that that you see offered by banks, they all get priced off of this and the expectation of where rates are going to be. And you've all been seeing CD rates coming up if you're looking at that over the course of the past year or two. As the Fed was engaged in this process, some people thought, well, they might overdo it a little bit. We might see a recession, but most expectations about that were that it would be fairly short, it would be fairly mild, it wouldn't really be, much of a big problem for us. The kind of outlook we were looking at was, well, maybe eventually that funds rate would get to 5.5. It would stay there for a while till the end of the year. And then once the inflation rate started actually coming down, and there was evidence that it was going to keep coming down from 6% to 5% to 4% and so on, then maybe next year the Fed would start backing off and start lowering those interest rates back down again, because as I showed you, their long run target of where they think neutral is for the Fed funds rate is somewhere around 4. So they got ways to go to get it down, or 3.5. So we were expecting maybe rates to start coming down next year. The inflation rate maybe would take till the end of 2024 to get back down to 2%, but it would be headed back down there. And we might get a little bump up in the unemployment rate over the course of all this. So that was kind of the broad path that was out there. But now we have a big wild card in the outlook, and that's the banking panic. So the fundamental problem at Silicon Valley Bank was a mismatch between the maturity of their assets and their liabilities. So let me explain, based on press reports, what I see going on. This bank grew very rapidly. This is a large regional size bank. It's around 250 billion. The biggest banks in the country, like JP Morgan Chase and Citigroup and others of that size, they're over $1 trillion. So this is a very large bank, but it's not one of the globally important systemic banks. But the thing is, it grew very rapidly between 2020 and 2022. Big influx of deposits. You've probably heard that their customer base consists of a lot of tech startup companies. And these companies were raising lots of cash in the IPO market. People were looking for places to make good investments because interest rates were so low. So they were getting a lot of funds from investors who were backing them. And they had more cash coming in than they could actually deploy for a while. So this money was coming into the bank. When money comes into the bank, bankers have to put it to use. So what do? Well, certainly they're loaning it out to some of their customers, but they don't want to make imprudent loans because that's too risky. So they want to make good, solid loans. So certainly they're doing some of that. But they, again, have kind of more money than they know what to do with right away. So they're investing a lot of it in high quality, meaning US government bonds of various kinds. And apparently they were investing them in long-term bonds, both treasury securities and maybe mortgage-backed securities backed by Freddie and Fannie, government-sponsored enterprises. So these are also, in effect, risk-free from a default point of view, because Freddie Mac and Fannie Mae guarantee the credit risk of those underlying mortgages and the bonds. So you could say, well, these are risk-free investments for a bank to make. And most banks hold some amount of their asset portfolio in these kind of risk-free bonds. Credit risk-free, not completely risk-free, as we'll see. Another attraction for having these kinds of securities is that there are huge markets available. You can sell them pretty easily, like all the time. So it's a good place to have some investments. The problem is that if you buy a lot of long-term bonds when interest rates are really low, and then interest rates become much higher, the value of those bonds declines. The reason for that is because investors who want to buy new bonds today could get, say, 4% on them, and the ones you bought are only yielding 1%. So if you want to sell them to an investor, the investor's not going to pay you face value. They go out and buy 4% bonds instead. So the investor says, well, I'll buy those bonds from you, but only if you sell them to me at a discount, like maybe 90 cents on the dollar or 85 cents on the dollar, whatever it takes for the new price to translate into a yield of 4%, which is what you could get on the new bonds, right? So as interest rates go up sharply, the value of that bond portfolio goes down. That's not a problem unless the bank all of a sudden needs to come up with a lot of cash. For example, suppose it has some really great opportunities to make fantastic loans that it could charge a lot of interest on. It might want to sell some of the bonds and then use the proceeds to make loans. It would lose money on the sale, but if the loans were much better, it might make sense. But another reason they might have to have cash would be if some of their depositors want their money out of the bank. And if a lot of depositors want their money out of the bank all at the same time, they have to sell a lot of those bonds in order to come up with the cash to pay the depositors. Even then, it's not a terrible problem if you don't have a lot of your assets tied up in these underwater bonds. You might have a lot of, like, say, cash deposits at the Fed, which is another form in which banks can hold excess cash. They could do that. But in this case, SVB apparently, in order to meet this large amount of withdrawals from their customers, would have had to sell so many bonds that they would have essentially run out of money. At least that was the rumor that started spreading around in the financial markets. The customers started saying, hey, we kind of have this knowledge now that they're holding onto a lot of bonds, they're underwater. If I don't get my money out, somebody else might get there before me. And word spread very quickly because the depositor base was a group of people who they all monitor social media, and they sort of all stayed in touch with one another through a network, and they all kind of got together and pulled their money out at the same time. So that's what precipitated the bank failure. as you know, a couple other banks got sort of dragged down at the same time, banks that maybe also had some similar problems. When bank failures, when there's the scent of danger in the air, bad news travels fast. And people who have any concern at all say, gee, my bank might be safe, but why should I take a chance? So that's a factor that sweeps through markets, and any bank that is even slightly suspect has to worry, even if it's a completely safe and sound bank. It's very difficult for banks to sustain a very serious, deep, widespread bank run because they're all at risk for depositors, coming. SVP also had this other really serious problem, which is that according to press accounts, as much as 90 to 95% of its deposits were above the FDIC insurance limits. Because these are big corporate, think about it, any business that has any kind of a cash balance has more than 250,000 if it's a large size company. So, a lot of banks are used to having corporate customers have balances that are more than 250,000. But at many banks, I think the average kind of is like 50% are insured and 50% are not insured, as far as these limits go. But at SVP, only like 5% of the deposits were insured. So they were particularly vulnerable to this type of a run. So what does all of this mean? Well, it means that even though it appears at the moment that the efforts to stabilize the banking system have been successful, things have been kind of quiet the last couple of days. Doesn't seem like the panic is spreading. I went through the financial crisis of 2008, 2010 when I was at the Fed. That thing bubbled, up and down for months and months and months. It seemed like everything was fine. And then another problem appeared, and then there was another set of panics again, and then that looked like it was getting fixed. And we ended up with a global financial panic, even though it began with just a few little drips and drops here and there. It eventually turned into a flood. So I think there's going to be some nervousness for a while, just to make sure that everything is, really kind of back in good shape. And as a result of that, the Fed is kind of between a rock and a hard place. Normally, it would be wanting to raise interest rates to deal with the inflation problem. But with the pressures in the banking system, a further increase in rates is going to put even more pressure on any banks that are holding these long-dated assets if they haven't hedged the interest rate risk. And that was another problem, with this bank, was that it had such big exposure, but it didn't have any hedges in place, apparently, or enough hedges in place to protect itself against raising interest rates. So at the moment, kind of most of I'll use the term smart money out in financial markets where people are actually, buying contracts, is that the Fed will raise rates next week by 25 basis points, kind of signaling that, hey, we know there's a problem out there. We would have gone 50. But now we want to be a little bit more careful. But I think they're kind of maybe concerned that if they don't raise rates at all and just say, well, we want to wait a little bit, that will cause some question about their willingness to, stay on top of the inflation problem. So it's kind of like King Solomon and the baby, I'm going to cut it down the middle sort of thing. So this panic has really complicated the environment. It's too early to really be complacent. The Fed has been doing everything it can to make liquidity available to the banking system. No one yet really knows how widespread the problems are. You can be sure all the banking supervisors around the country, no matter if they're working for the Fed or the FDIC or the comptroller of the currency, all the state bank examiners, they're probably all examining carefully all their reasonably large size institutions, going over them again, trying to see if there's any lurking problems that maybe they haven't seen. So there'll be a lot of that going on. Because of the nervousness in the environment, you're going to see banks maybe on the margin slightly more reluctant to make loans. They're going to want to hang on to whatever liquidity they have and not tie up their capacity to provide cash to depositors if anybody wants to have their money out. So the credit market conditions are going to be tightening on their own without the Fed having to raise rates. If you think about this general term, financial market conditions, whether they're tight or loose, what I mean by that is it easy to get money if you want to borrow it, and can you borrow it cheaply or is it expensive? Financial market conditions are going to be tightening on their own without the increase in interest rates that the Fed might want to impose. And that's another reason why the Fed will want to tread carefully. It already knows that this tightening up in the financial markets where banks are going to husband their resources and kind of hunker down a little bit, in and of itself will slow down maybe home sales because mortgage credit will be less available, car sales, things like that. On the margin, there'll be less credit available. So we're going to see tightening in financial conditions even without the Fed taking an action. And it may take, another few months before any of us really has a sense of whether the environment has returned to kind of a more safe, stable one or not. It's just a lot of uncertainty out in the market for now. So this is just a snapshot I took on Thursday from the CME group. It's a financial exchange. What's the probability of the funds rate? Where is it going to be? I labeled these columns 1, 2, 3, 4. You want to look at the right side first. So a month ago, the expectation was that 85% probability that the Fed funds rate would go from its current, which is in the 450 to 475 range, up to 475 to 500. That would be like a 25 basis point increase. So that was like a month ago. A week ago, before SVP, the probability shifted to a 50 basis point increase. Why? Because the inflation report wasn't as good as people were hoping it would be. It showed inflation rate was still too high. And the labor market report was stronger than people thought it would be, showing the economy might be able to withstand a higher interest rate increase from the Fed. So even from a month ago to a week ago, the market shifted from a 25 basis point prediction increase on the part of the Fed to a 50 basis point increase. And then the day before I took this snapshot, which would have been Wednesday, it was kind of a 50-50 thing. And then it kind of settled back down to, hey, we think the Fed maybe will go for 25 basis points. So every day, probabilities are changing as people get more and more information about what's going on and kind of reformulating their views. So now we have time for discussion. And one reason I like coming here is because you guys are well informed and you like to talk about things. So we have some time to do that. And Jonathan's going to moderate us.
Thank you, Dr. Sniderman. It's now time to turn our Q&A session over to Laura. No? Oh, okay. Nancy, and if you would like to be added to our weekly email notification list, please fill out the form on the clipboard that will be passed around. Online viewers can add your name to the chat box. It's Q&A time now.
In your one or another of your charts, you spoke of some sort of a rent component, even an imputed rent for homeowners.
Right.
And I suppose this is intuitive or self-explanatory, but I'm just asking to be sure. What are the okay, you described the rent component as a major part of all the stuff you're talking about, but what are the major components of the rent factor?
Well, there really isn't. So think about the term shelter costs might help. Shelter costs are how much does it cost us to operate our home, whether we own it or rent it? So if you're a renter, you pay rent, but you also pay for water, you pay for electricity, you pay for gas. You have other kinds of maintenance services that you pay to maintain your shelter. So in the consumer price index, there's a whole section on shelter costs, and they have different lines for each of these utilities and the rent and so on, maintenance.
So it really is just kind of components composite.
Yeah, so that's for all shelter. But then within that, the biggest one, of course, is rent. Now, if you're a homeowner, you also have all the various utilities and so on, but literally you're not writing a rent check. So you don't have that. But implicitly, we are kind of renting our homes from ourselves in the same way that you could think about if you rent a car, instead of own one, you're paying rent on the car or leasing it. If you own the car, you've purchased a capital good that provides transportation services, and every month you're in effect kind of renting it from yourself. I mean, that's the methodology, that's the philosophical way that the consumer price index, the Bureau of Labor Statistics, thinks about these capital goods that we own, whether it's a home or a car. It's providing us with services that we could rent in the marketplace, but we've chosen to purchase an asset that provides the same services. And so they impute to us a cost, a rental cost of owning the car or owning the house.
How much did the repeal of Dodd-Frank play in this last crisis?
Well, I'm glad you asked that question. One of the, I've been feeling very disappointed, but not surprised at how much discussion there's been in the wake of the SVB problem about everybody knows what the mistake was. Like, everybody's pointing fingers right away. I don't think we really know enough about this to actually, be able to say. There's going to be a pretty thorough review of this, but right away, there's been recriminations about the legislation and so on. I just don't think we know. I guess the one thing, so I'm going to answer your question in a little bit of a roundabout way. One of the greatest things from my point of view that came out of the Dodd-Frank legislation was the idea that banks that are systemically important have to undergo stress tests. And a stress test it's like an exercise in which banks are given scenarios of things that could happen. And they have to be able to simulate out what the effect of those macro events would be on their portfolio, and whether they would have enough liquidity and capital to withstand the stress that those scenarios would place on their banks. And in addition to satisfying regulators that they could pass the stress test, they also have to be able to demonstrate to their supervisors that they have the management skills and computer systems technologies and data to be able to run these scenarios and manage their own risk internally, even if the regulators didn't ask them to do the stress test. In other words, they have to demonstrate competence in risk management and the ability to do this on their own. When that legislation was initially passed, I think even banks as small as $50 billion were subject to some kinds of stress tests. And many people, including myself, thought that that threshold was way too low because even though that sounds like a lot of money, $50 billion, those banks are not really big enough to cause macro disturbances. They're pretty easy to resolve as far as a bank failure by the FDIC. I mean, they really would not cause systemic problems. So the thresholds were raised, but I think they were raised way too high. And I was not in favor of how high they raised them, and there were, some other objections about that too. I think that if that bank had been subjected to the stress tests, requirements, and these were not repealed in 2018. So that's why this particular aspect of what got repealed in 2018, I don't think would have affected SVP. But I just saw a story this morning, actually, in the Financial Times that said that last year, or somewhere around either last year, a year and a half ago or so, the bank hired BlackRock, a subsidiary of BlackRock, which is a very large financial firm, to analyze its risk management systems and let it know kind of, where it stood. And that BlackRock told it that it lagged behind its peers on 11 out of 11 different measures of risk management, and indicated that, you got some work to do to figure out how to do this. And in particular, it said that it didn't have the capability of analyzing on a daily or weekly basis what effect changes in interest rates like we've seen would have on its portfolio. Because what seems to have happened here is that, and this is what, will come out, because Federal Reserve Board Chairman Jay Powell said the Fed is going to launching an investigation into kind of what went wrong from a supervisory point of view, both what happened at the bank and why this wasn't detected, and that the results of this will be made public sometime by May. So I don't think we have to, wait too terribly long. It doesn't seem like a complicated problem to manage. I mean, it seems like this is pretty kind of credit risk management 101 to figure out how to understand the exposure that you have on your balance sheet and take some actions to offset the risk. So A, the bank seems to have misjudged it, but B, why wasn't it picked up by the bank supervisors? And in this case, the bank evidently had supervisors from the state of California that supervised the bank itself. And then there's a holding company that owns the bank and some other subsidiaries. And that holding company would have been supervised by the Fed. San Francisco Fed would be the place where that would happen. So you've got the state of California, you've got the Fed at the holding company level. And what did they know and when did they know it? And did they try to warn the bank? Were there some supervisory efforts already in place to try to impose some discipline on the bank when all this kind of blew up in its face? I think these things will come out. But it seems like in an environment where everybody has known for the past couple of years that interest rates were going to be moving up pretty smartly, that financial institutions that kind of know what they're doing would be prepared for this, And this bank grew really fast, like I said, and had a lot of cash coming in. I even heard this morning kind of one person make the ironic comment that if the bank had actually taken more of the money and used it to make loans rather than invest in these long-dated, supposedly super safe, because they are safe from a credit risk point of view. They're not going to lose any money from defaults on investing in U.S. Treasuries, well, unless we get a debt ceiling problem and the government isn't allowed to pay its bondholders. But barring that, there's no credit risk in what they did, but they had huge interest rate exposure. If they had made a lot more loans, maybe the depositors who otherwise were nervous might have said, oh, we don't see them losing a lot of money on their bond portfolio. We just see a lot of loans on the balance sheet, and that's fine. So that's kind of an irony. You think banks get into trouble for making bad loans, and this one got into trouble for simple interest rate risk management.
So I have a question from Mies, who's in our virtual audience. I know we have a number of questions here, and hopefully we'll have time in the next few minutes to get to them all. Her question is, the Canadian government has a different regulatory structure than the US bank. Our regulatory oversight failed in the recent bank failures. Why can't the US government arrange a regulation of the banks through an entity other than the Federal Reserve?
Well, they could. There have been a lot of proposals over the years to do that. Canada has fundamentally a very different banking system, too. Canada has maybe 8 large banks, and that's it. We have like 3,000 banks of all different sizes. So it's a lot easier. Those banks are a lot more diversified. It's easier to supervise 8 banks because there just aren't that many of them. I don't know that I mean, again, it'll be instructive to see what comes out of this review of this institution to kind of find out where the failure was. And if it was something fundamental about the Fed or state of California, maybe a lack of communication between the 2 regulators, somehow or another. But yes, we have state chartered institutions and they get supervised by their state agencies. We have the FDIC supervising some. So we have a very, I don't want to say fractured, but a fractional, I mean, we don't have any one regulator that's in charge of all of them. That's kind of like all spread around and having to be coordinated. And this has led to some problems in the past. So that's another problem with the way in which we do supervision. It's divided up. Yeah.
Oh, do you think the massive layoffs in tech industry and particularly Silicon Valley was a factor in people's and businesses taking their money out to start with?
It doesn't, I mean, I haven't seen anything that would suggest the layoffs are the problem. It doesn't seem that people taking money out of the bank were people who were employees who were laid off and needing to get money out. It seems more likely that these were firms that raised a lot of money from venture capitalists. They had big deposits in the bank. We're seeing that the environment was difficult for raising more funds. So they were burning through their cash and so they're spending cash and they're taking money out, and the bank, in order to meet the needs of the depositors who are withdrawing, has to liquidate these securities. And as it does so, it's incurring losses. And then the word starts getting out, hey, wow, they've got a lot of these securities. And every time, this happens, they're losing more money. Maybe we should get our money out now. And then the word seemed to spread, like wildfire it is said, through social media and other. One of the mechanisms seemed to be that the VCs themselves, who helped to launch a lot of these companies, all you needed was 5 or 6 of them to send messages to all of their companies and say, get your money out. And, it happens pretty fast.
This question is about how the Fed makes its decisions about raising interest rates. So historically, when there's inflation, it's because demand gets ahead of supply. So raising the interest rates squelches the demand, fights inflation. Certainly with regards to some parts of the economy, like housing, when the Fed raises interest rates, that causes home values to go down because people are paying a higher rate. They can't pay as much for their home. But in other parts of the economy, there are lots of commodities today that are going up in price for reasons that have nothing to do with demand and supply. So when I look at individual commodities, let's just take 3. The price of cars and other equipment that use computer chips is going up because the price of computer chips is going up because of supply chain issues. Fertilizer, the price of fertilizer has gone up. Well, a lot of fertilizer comes from Russia and the Ukraine. Eggs and chickens, the price has been going up. Well, there's a bird flu. My question is, does the Fed take into consideration these individual reasons for individual commodities going up when it raises the rates? Because raising the rates will have no effect whatsoever on the inflation on these types of commodities.
Well, sure it does. And one thing to think about, so, you made the comment it has nothing to do with supply and demand for some commodities, but in your own explanation, you indicated it's actually a supply issue. So it does have something to do with supply and demand. In this case, it's the supply that's short relative to demand. because of the pressures you indicated. But think about this for a minute. Suppose the price of a dozen eggs goes from $2.50 to $5. So that's 100% increase in eggs. Once it reaches $5, if it just stays at $5, there's no longer any inflation in the price of eggs. So what you're seeing is the inflation rate rises until prices reach their new high level, which they have. And then the inflation rate goes back down to 2% or so, adjusting to the new supply demand conditions. That's kind of one of the things that goes on here is the cost of everything goes up, but the inflation rate will die back down. And that's taken into account when they think about what they're doing.
Thanks again, everyone. Thank you, Dr. Sniderman. That was excellent. I'm so glad you could join us. This is our last forum until fall. Our committee is considering changing the calendar schedule to first and third Sundays with a longer year instead of our current 3 times a month with a shorter session. We want to hear from you. Please email us your opinion and any suggestions for topics at forums@uucleveland.org. You are welcome to attend our 10:15 a.m. service either upstairs or in the sanctuary or on your YouTube page. The theme of our service today is the theme of our service today.
I thought I gave it to you.
Don't have it.
I'm sorry. I
oh,
thought I gave it to you.
Okay. To follow. By the way, Lori Albright, do you want to make an announcement, please, while we're dredging up the theme for today's service?
I do. Just, I think most of us in this room are aware that there's a proposed constitutional amendment that there's signature gathering occurring starting today. And I have petitions in the back of the room. Anybody who's in Cuyahoga County who would like to sign is welcome to do so. If you're from another county, I can get another set of sheets, so just let me know. But I'll be right in the back of the room. Thank you for the support.
The service today is Senior Sunday, and the seniors in our seniors meeting, seniors in high school are leading the service.
Oh. All right. Well, thank you for joining us and have a great week.